Hello everyone, we are from Group 8. Our topic is Irrecoverable Letter of Credit at OCBC Bank. My name is Kumari Somasundaram and my metric number is 281027 from Group A, and my teammate name is Nurhanis binti Zolkefle. Her metric number is 272493 and from Group B. Now, the definition of irrecoverable letter of credit at OCBC Bank. An irrecoverable letter of credit is a guarantee from a bank issued in a form of a letter. It creates an agreement where the buyer's bank agree to pay seller as soon as certain conditions of the transaction are met. Now is the salient features of the irrecoverable letter of credit. Their main features is cannot cancel or amend or edit without consent of all parties. Second is purpose. The purpose of the credit irrecoverable letter of credit is so that they cannot be changed or cancelled without the consent of all parties, including the buyer, the seller, and the banking institution that are engaged. Third is parties who are involved. Issuing bank, the importer, exporter, advising bank, confirming bank, remitting bank, and also paying bank all are engaged. Now I'm going to explain you the obligation of irrecoverable letter of credit under OCBC Bank. OCBC Bank, who act as an advising bank, verify the validity of the letter of credit issued by the exporter or beneficiary. The bank that gives the credit advice to the beneficiary, it's not always liable for making good on the credit. The obligation of the issuing bank to assure that the exporter that subject to the terms and circumstances of the letter of credit, payment will be made to the exporter upon presentation of paper that are in compliance with those terms and conditions. Next is right of each party in an irrecoverable letter of credit under OCBC Bank. The OCBC Bank, who act as an advising bank, has right to give advice to the beneficiary or the exporter, and it is not always liable for making good on that credit. Letter of credit have their own unique set of guidelines they must be followed. The exporter must take considerable time to make sure that the documentation is present, precisely and entirely match the provision of an irrecoverable letter of credit, and even slight fault might delay or forbid payment. Now I'm going to explain you how the irrecoverable letter of credit transaction occur. There are few steps in OCBC Bank who act as an exporter bank to create an irrecoverable letter of credit. Firstly, the importer will approach the issuing bank for the letter of credit after the sales contract has been signed by the both sides, which is exporter and importer. Next, the issuing bank issue a letter of credit to OCBC Bank, which serve as an exporter's advising bank. Then the OCBC Bank also act as a confirming bank to use an irrecoverable letter of credit. The OCBC Bank will then confirm its authenticity before delivering a copy of irrecoverable letter of credit to the exporter. Once the exporter has received the irrecoverable letter of credit, the exporter can organize the shipment. The exporter present the bill of lading or other relevant document to OCBC Bank. OCBC Bank will verify the exported document, ensure its acceptance of the terms and condition of the irrecoverable letter of credit. Now the OCBC Bank forward the document to issuing bank. Then the issuing bank forward the document to importer and obtain payment. Then the payment forward to OCBC Bank. OCBC Bank act as a remitting bank paid to the exporter.
Assalamualaikum and selamat sejahtera. My name is Nurhanis binti Zolkefle, metric number 272493. I'm from Group B. I'm going to continue the presentation with the cost to the issuer. Seller might be forced to pay their bank. For instance, the amounts paid in advance by the seller are kept at the bank until the deal is finished. After the sale is over, a seller who has enough credit and collateral pays the bank back the amounts paid in advance. Next, I'm going to continue with the cost to the subscriber. The cost of letter of credit issuance commission from OCBC Bank per month or part thereof is 0.10% per month with a minimum of 100 ringgit Malaysia, in which applicable, cable is 100 ringgit Malaysia, rentas is 5 ringgit Malaysia, and GIRO is 30 cent. Cashier's order issuance is 2 ringgit Malaysia and stamp duty is 15 cent. Processing fee is 50 cent and for postage is 5 ringgit Malaysia. Adding on, the courier charges for West Malaysia and East Malaysia will be 16 ringgit Malaysia and 24 ringgit Malaysia respectively. For overseas postage, it will be charged according to the destination. The payment will be free for the first 2 months and are charged 30 ringgit Malaysia for each subsequent tracer. In the case of irrevocable letter of credit amendment that is increasing the amount or extension of irrevocable letter of credit validity period, the commission per month or part thereof will be 0.10% per month or minimum of 100 ringgit and the cable will be 40 ringgit Malaysia. Meanwhile, for the risk and return to the subscriber, the beneficiary of the letter, who is typically the seller in a transaction, will have more assurance on the payment. Unexpected changes to the political or economic climate may not be covered by the irrevocable letter of credit provisions. Subscribers should be certain on external payments because it may not be honored by local banks in the buyer's country due to exchange regulations. The subscriber should be aware that the important nation has significant external debt or high debt service relations, a persistently negative balance of payment, or a history of making international payments late or in default. After that, I'm going to talk about risk and return to the issuer. Banks are subjected to linked transaction security risk exposures. There are 3 different kinds of hazard associated with irrevocable letter of credit transactions. The first one is the danger of not being reimbursed after making a payment to the beneficiary, which is related to the customer's financial situation and also credit history. The second one is the nature of the traded products may cause the account party to become bankrupt due to the high degree of price fluctuation. The last one is probable that the issuing bank will not be compensated. When the applicant rejects the documentation and the issuing bank fails to properly implement the reimbursement, there are instances when fraud might occur in honoring a letter of credit by verifying the bank. The only way to ensure that the bank has included recourse clauses in contract of negotiation with the beneficiary is to reduce the risk of fraud. In such a case is to confirm it. Is there any other cost elements or any other hidden costs in irrevocable letter of credit? The rates and commissions mentioned are for a single transaction only. Any additional or hidden fees for remittance, mailing, and courier service will be assessed based on the usage and also location. Taxes that are applicable to the total fees, charges, and commissions indicated must be paid if there is any. Is there any pricing mechanism or any formula for irrevocable letter of credit? An irrevocable letter of credit typically falls between 1 and 2% of the contract's agreed upon sum. The cost is influenced by the type of irrevocable letter of credit utilized, the customer's credit history, term, safeguarding provisions, and a number of other variables. The rate is also influenced by the bank chosen because they will increase the irrevocable letters credit margin. Lastly, I'm going to talk about is there any official guidelines for the product establishment. The majority of letters of credit are governed by the Uniform Custom and Practice for Documentary Credits, which was established by the International Chamber of Commerce. On July 1, 2007, the UCP 300 version, which is the most recent one, went into effect. However, the UCP 600 does not offer specific guidelines regarding the nature of irrevocable credit. Because of this flaw, in the UCP 600, it is still possible to refer to the rules governing the UCP 500's irrevocable credit. It also is recommended for convenience sake that the next UCP explicitly include the irreversible credit characteristics.
Assalamualaikum and good day to Dr. Shahril. My name is Ain Shafiqka binti Muhammad Kasim and my matric number is 280262. Here I will present one of the services that we chose, which is the Ocean Bill of Lading. So what is Ocean Bill of Lading? An Ocean Bill of Lading is a crucial document in the international trade, including the import and export by the sea transportation. With an Ocean Bill of lading, goods may be carried across the international waterways. For this instance, OCBC Bank will serve as the exporter bank in the exporter nation. This agreement serves as the contract between the shipper and the carrier. Then, let us see the purpose of the Ocean Bill of Lading. This agreement serves as the contract between the shipper and the carrier to ensure that the exporter will be paid and the importer will get their products. This document was intended to expedite the delivery of product by means of shipper and carrier who handle the item en route. The paperwork includes the particular information about the type of shipment, including what and how much the material is being carried and where the product will be delivered. Move to the salient feature. As the other services, Ocean Bill of Lading has its own salient feature, which is the document will include the name and address of the sender and the recipient, the date of delivery, amount, precise weight, value, and classification of goods. The Ocean Bill of Lading comprises the information such as the nature, amount, condition, destination, and location of the shipment as a receipt and invoice with a legal claim. Next is the loading and discharge part that specifies the port where the good will be loaded onto the ship and where they will discharge. Ocean Bill of Lading also has the carrier liability, which shows set out of the carrier liability for any loss or damage to the goods during the transit. Next, let's see how does the importer or exporter to use the Ocean Bill of Lading. Importer and exporter will use this document as a proof of ownership because it serves as evidence that the goods have been shipped and the importer or exporter is the rightful owner of the goods to clear the custom. To obtain financing, the Ocean Bill of Lading can be used as the collateral for a letter of the credit or the other form of financing. Meanwhile, to track the shipment, it must include the information about the voyage, such as the vessel name, voyage number, and the expected arrival date, which can be used to track the shipment progress and as a claim for the damages or losses of goods in transit. The importer or exporter can use the Bill of Lading to make a claim against the carrier. The Bill of Lading made as the document for a payment, including the freight and charges, by the importer or exporter, and once the goods arrive at the port of destination, the importer or exporter can use the Bill of Lading to take the delivery of goods from the carrier. Last but not least, the Ocean Bill of Lading serves as the negotiable instrument and can be transferred to another party by the endorsement and delivery. This can be useful for the importer or the exporter if they want to sell the goods to another party because taking the delivery. Next is the party's obligation. As is a common knowledge, each party to the contract has its own obligation. When the products are transported internationally by the waterways and the ocean bill of lading is required to finalize the transfer of goods. If the product must be transported deeper into the target country and away from the port, they must be accompanied by the inland bill of lading. Therefore, the importer-based dealership, which is receiver, we sign the ocean bill of lading with the exporter, which is the shipper, in order to deliver the automobiles to the importer nation. When the products are collected, the contract is given to the shipper. Both shipper and carrier are required to sign the paperwork. The paperwork is delivered to the recipient upon the completion of the shipping. After delivery and the recipient, the contract must be also signed by the recipient. As for the bank, OCBC bank obligation is to ensure that the bill of lading is valid and authentic. This typically involves the verifying that the bill of lading has been properly issued and signed by the carrier, and that it accurately reflects the term of the underlying contract of the carriage. Last but not least, the ocean bill of lading serves as the negotiable instrument and can be transferred to another party by the endorsement and delivery. This can be useful for the importer or the exporter if they want to sell the goods to another party because taking the delivery. A bill of lading is a document that serves as the contract of the carriage and receipt for goods shipped by sea. In the context of ocean bill of lading, the right of the parties involved will include the shipper, the receiver, and the holder of the bill of lading. As for the shipper, which is the party who is sending the goods, has the right to expect their goods will be transported to the specified destination in the timely and safe manner, and the carrier will provide a bill of lading as the proof of shipment. The consignee, who is the party receiving the goods, has the right to expect the delivery of the goods as described in the bill of lading, and to take the possession of the goods upon the delivery. And lastly, the holder of the bill of lading is whoever holds the physical document has the right to take possession of the goods or negotiate the bill of lading as the document. The holder of the bill of lading is whoever holds the physical document has the right to take possession of the goods or negotiate the bill of lading as the document of title.
Assalamualaikum and good day to Dr. Shahril. My name is NurFatihah binti Ahmad, meter number 280286. So I will proceed with the cost of creating the instrument to the issuer. OCBC Bank may charge a fee for preparing and processing the documentation such as the bill of lading itself and the commercial invoice. Then they may charge a fee for handling the cargo and preparing it for shipment, such as for loading and unloading the cargo or for the unpackaging. Then, they will also suggest to the customer to purchase marine insurance in order to cover the risk of loss or damage to the cargo during transport. The last one, OCBC Bank might have operational costs such as staff costs, IT, infrastructure costs, and others to create the bill of lading. As for the cost of holding the instrument to the subscriber, the subscriber are responsible for paying the shipping line's charge because we does not have access to the real seller and buyer. Then, there are a variety of parties could be engaged in a sea freight shipment. The subscriber responsible for paying the sea freight costs or other carriage-related fees for the convenience of trading operation. As for the risk and return to the issuer, the first one is credit risk. OCBC Bank assume that customer may default on their payment and may not be able to repay the bank. Then, the bank is facing the shipping risk as the cargo may be lost or damaged during the transit, which would result in a loss for the bank. The third one is regulatory risk, since they must comply with international shipping regulation and laws when issuing a bill of lading. Then, the return that issuer gets is They may earn interest income on the fund advanced to the customer for shipping the goods and charge the additional fee for the service provided, such as handling fee, documentation fee, and so on. For the part risk related to the subscriber, the risk that they face is shipping risk, because the subscriber still have to pay the goods shipped, even if the cargo is lost or damaged during transit. Next is regulatory risk, since they also have to comply with international shipping regulation and laws when obtaining the bill of lading. And the return that subscriber get is they have access to the trade financing from OCBC Bank, which allow them to purchase goods and services without pay upfront. Then they are able to negotiate better terms with suppliers and achieve cost savings by using an ocean bill of lading. Then, other cost elements that include is OCBC Bank may charge a fee for preparing and processing the documentation required for the bill of lading, such as the commercial invoice. And they also will suggest the customer to purchase marine insurance in order to cover the risk of loss or damage that occur. Next, OCBC Bank may charge a fee for storing the cargo before it is shipped or after it is received. As for the pricing mechanism, ocean-based lading pricing mechanism is based on the freight risk, which is the cost of shipping a certain amount of goods on a specific route. In OCBC Bank, the pricing mechanism of ocean bill of lading may vary depending on the type of service offered and the term of the contract between the bank and the customer. Then, official guideline of ocean bill of lading is the process of issuing bill of lading for ocean freight is covered by international shipping regulations, such as the Hagibis rules and the Hamburg rules. And OCBC banks, as a financial institution, would have their own internal policies and procedures in place for issuing bill of lading, which would be based on industry standards and regulations.
Overdraft is temporary line of credit that approved by a bank to account holder. This happens when checks are produced against an account and the amount of cash in the account is greater than the check presented. The bank will issue the account holder an overdraft, which is a short-term line of credit. Overdraft can be help to some people as it can help to avoid return payment and fees for a bounce. This scenario occurs when the users want to make payment but don't have enough money in it and give alternative to use overdraft for emergency. The reason why overdraft is created is to help customers make transactions when they don't have enough money to make the transaction. The overdraft is created to help customers who don't have enough amount of money to do transaction. Thus, bank giving solution by giving overdraft to the customer. The borrowed money is subject to interest charge or overdraft fees from the lender, and it must be paid back within the allotted time frame. For instance, a company only has a 5,000 ringgit Malaysia in cash on hand. They must pay 3 checks totaling 3,000 ringgit Malaysia in order to cover the expense. The overdraft might be used in this situation to pay off the unpaid check balance. As the account receivables are paid, the account balance will be restored. Also, OCBC Bank help customers by allowing customers to cash their assets and extra funds up to the customer approved credit limit. The salient feature of overdraft is overdraft limit is different from borrower to other borrowers. Next, an amount can be withdrawn or deposited at any moment in an overdraft account up to the set limit. After that, the bank assesses interest on the amount of the overdraft, which is calculated daily and billed to the borrower account each month. In the event that the borrower fails to make the required payment, interest will increase. Not only that, in the case of early loan repayment, banks do not impose prepayment penalty on the borrowers. This distinguishes this trade from those found in other types of loan. Lastly, in bank overdraft accounts, the ME system is not applicable. The borrowed money may be repaid in many installments of borrowing price. By withdrawing more money from customer current account than is in it, or by going overdrawn, customer can borrow money through his or his current account. This usually comes with a fee. Remember that an overdraft is a form of loan. A matter customer can request one from his or her bank, or they may just provide it to customer. If customer must borrow money, there may be less expensive options. It's crucial to always look for the cheapest borrowing option. The parties that are related to overdraft are bank and the customer bank. Bank is the one that gives overdraft to the customer who don't have enough money to do transaction. Next, customer bank is the one that don't have enough money in his or her account to do transaction. For instance, the customer account OCBC bank don't have enough money to do transaction, and the bank will give alternative and additional loan that called overdraft to the customer. The obligation of bank is to give additional money to help the customer or borrower to do transaction. If a bank did not step in, a customer payment will either be declined or in the instance of physical check will bounce and be returned unpaid. Next, the obligation of borrower or customer account ensure overdraft is only used up to the authorized limit and at the end of each month, interest will be calculated based on the daily outstanding sum and will be deducted from the overdraft account. Next, timely payment of money interest fee and timely repayment of the overdraft facility as required by the OCBC bank. Lastly, when the SBR changes and the money installment amount that the client must pay changes, as a result, the bank will send the customer at least 7 calendar days notice of the new money installment amount that the customer must pay. The right of borrower in overdraft is the borrower can withdraw from the agreement overdraft within 40 days after entering the overdraft agreement. In accordance with clause 11.1 of the agreement, the borrower is required to repay the entire amount of the overdraft that was used by the borrower as well as interest accrue up until the date of repayment of the overdraft immediately, but no later than within 30 days from the submission of the notification of withdrawal to the bank. Otherwise, it will not be considered that the borrower has withdrawn from the agreement. The right of bank or lender, if the customer is unable to pay their obligation, the bank has the authority to sell the customer the asset in order to recoup their debt. You are still responsible for the shortfall if the proceeds are insufficient. It's rare until borrower run into financial trouble. The bank has the power to demand repayment of borrower or overdraft at any moment.
In the instrument of overdraft of the OCBC bank issue, there is no any costing that caused by this instrument. Only the overdraft amount that the bank pay for the subscriber for their existing transaction for the payment that over their amount in account. So in the perspective of the subscriber of the OCBC overdraft instrument, holding cost of this instrument is committee fee, a fee of 1% annual of the portion of the overdraft that not used each day in a case where the total of agreed amount of overdraft facility with the bank exceeded 250,000 ringgit Malaysia or other maximum that the bank may decide upon. Some more, there is a fee of interest on overdraft exists. If the overdraft limit is exceeded for any reason, interest will be charged on the amount over the limit from the date it is incurred until the date it is settled. As the risk that occurs to the bank is the credit risk where when a customer is unable to repay the debt, the bank is frequently responsible to taking the hit and will probably lose a valued customer. Moreover, when the interest rate raised, more customers of the overdraft didn't make the repayment will cause a liquidity risk of the bank and chance of suffering losses and result of failing to make payment on time when they are due or failing to so that cost is measurable. And for the return for the instrument for the bank is the interest that pay back by the subscriber monthly and the commitment fee that need to pay annually by them as issue the overdraft from the OCBC bank. For the risk that subscriber of the OCBC overdraft instrument will face is the interest rate. For the overdraft facility adjust in order with the change in standardized base rate and is set a rate currently published by the bank. The higher the interest payment may necessary as a result of increase the efficient loan rate. So beside it, the subscriber must ready to provide additional security or repayment for the overdraft facility also. So as the return of this instrument to the subscriber is then don't have when they don't have enough fund in their account to cover a transaction, the bank will pay it based on the subscriber overdraft terms. For the instrument overdraft of OCBC Bank, there is no other hidden element cost than bank or subscriber that need to pay or cost. It's only cost the repayment and the cost of the commitment only that is stated for the transaction of this instrument from OCBC Bank. For the pricing for this instrument from OCBC Bank is stated in two different ways. First way is the overdraft facility secured against time deposit. The minimum limit of this instrument is 10,000 ringgit Malaysia and not exceed 5 million ringgit Malaysia per subscriber. And the second one is the overdraft facility secured against fixed deposits with a minimum limit of 5,000 ringgit Malaysia per facility and not exceeding 5 million ringgit Malaysia per subscriber. The effective lending rate per year is computed as the standardized base rate plus the interest rate. The change of the benchmark rate may cause the standardized base rate increase or decrease. There is an official guideline for the instrument for the overdraft that announced by the OCBC Bank. From the guideline, they stated the terms and conditions to issue the instrument, the legal law that occur in the agreement to protect such as the Financial Service Act 2013, the guideline on credit transaction and exposure to connected parties, and other guidelines that are direct issued by the Bank Negara Malaysia, and the Anti-Money Laundering, Anti-Terrorism Financing, and Process of Unlawful Activities Act 2001. But for the more information of the instrument, the subscriber can seek for the nearest branch of the OCBC banks. That's all from me. Thank you.
Good day, sir. My name is Lam Wei Kiat and my matrix number is 280010. Today, I will talk about a shipping guarantee. A shipping guarantee is a facility that helps importer to obtain goods that arrive at the port before the original documents do. When the vessel carrying the goods arrive earlier than the shipping documents, the importer will have to wait for the shipping documents to clear custom duties and other formalities. Importers incur heavy demurrage charges when the containers are left in the port beyond the allotted free time. So a delay in the arrival of the shipment bill of lading or other shipping documents will lead to a higher demurrage charges for the importer. To avoid demurrage charges, importer can approach a bank for a shipping guarantee. Next, I will talk about the shipping guarantee process. First of all, the importer will submit the applications for a shipping guarantee to their banking institutions with whom they have maintained a credit line. Next, after reviewing the applications and the copy of the invoice and the bill of lading, the bank issues the shipping guarantee to the importer. Using the shipping guarantee, the importer can pick up the goods from the carrier, clear custom formalities, and move the goods to their warehouse. When the shipping documents arrive at the importer banks, the banks review the documents and hand them over to the importer. Next, the importer substitutes the shipping guarantee with the original bill of lading at the shipping company. Lastly, the importer returns the original shipping guarantee to the issuing bank. More than that, I will talk about the advantages of shipping guarantee. The first advantages is faster turnaround time. The importer do not have to wait for the shipping documents and they can take the delivery of the goods immediately. A shipping guarantee will minimize the delay in the supply chains and importer will not miss any business opportunities. Next is cost saving. As the shipping guarantee enables importer to pick up the goods before making payment and furnishing the original documents, they can begin the sales or production process using the shipped goods. Around the time the importers receive the original shipping documents, they will have enough liquidity to complete the payment for the goods. Lastly, improve cash flow. Using a shipping guarantee, importers can move the goods out of the port and complete the custom clearance formalities without the shipping documents. This enables them to lower total demurrage costs.
My name is Lim Mao Siang and my matrix number is 279676. The issuer creating cost for the shipping guarantee will be charged under two conditions. The first condition is under document processed through bank charge a 75 Singapore dollar flat. The second condition is under document not processed through bank charge of a 0.125% of the invoice amount. This charge is also with a minimum fees of 75 Singapore dollar. Besides that, for the subscriber holding cost, the outstanding guarantee on shipping will be charged on 1 month from the issue date. There is an additional charge the amount of 0.5% of the invoice amount for 2 months with a minimum fee of 70 Singapore dollar per 2 month applied. The risks involved for the issuer during the application of the SG include penalties if the issuer fails to fulfill its obligation. If the applicant is unable to reimburse the amount paid to the beneficiary, this item will be deemed delinquent and charge a penalty interest rate of PLR plus penalty per annum until the repayment date. The trade facility of the issuer will be frozen instantly, while for the return of SG to the issuer, allow the importer to take delivery of goods instantly. In addition, this convenience contributes to the elimination of storage, demurrage, handling costs, as well as the prevention of potential losses due to the deterioration of the goods. Now for the risk that is incurred by the subscriber, first may include loss protection and the need to make payment in accordance with the letter of credit or collection bill. Even in the event that the document they are subsequently received contain irregularities or error. Second, following receive a claim that has been made against SG. The bank will continue proceed to pay the shipping company and will have the authority to debit the importer account for the amount that has been claimed. Third, the fluctuation of the foreign exchange rate was the risk that was involved if the SG was issued in a foreign currency. While for the return to the subscriber of the shipping guarantee contribute to an improvement in cash flow. The importer will have less problem with their working capital since they immediately begin the process of sales or process of producing item when the imported good arrive, which will also increase their ability to manage their cash flow. In a good result, the importer can generate more profit. There are no any extra cost component or hidden costs able to obtain in the relevant website. Hence, we assume that the process of applying and providing a shipping guarantee does not involve any extra cost component or hidden cost. The pricing mechanism will be the commission of 0.1% per month assessed for the 3 months after a shipping guarantee is issued. There are either one of two fees associated with the issue of an SG, one for letter of credit with a minimum of 50 ringgit and another one for documentary collection with a minimum of 100 ringgit. However, after 3 months from the date of issuance, a fees on commission per year at 0.550% will be assessed for any SG that has not been redeemed or cancelled. There are also no specific official guideline able to obtain for the establishment of the SG published in the relevant website. However, the Ocean Bill of Landing and the shipping guarantee is almost the same, so the official guideline of the Ocean Bill of Landing will be used as a guardian for the shipping guarantee. A banker acceptance is applied when the importer will attempt to make a purchase with the exporter in order to get the approval of the bank. However, both the exporter and the importer need assurance about the other party's ability to fulfill their respective order. In this case, banker acceptance are often used to seal the deal on this international trade and finance the transaction with relatively lower risk for both parties. The purpose of a banker acceptance allows the issuing corporation to make a transaction without taking on additional debt, while the bill represents a guaranteed method of payment for the receiving corporation. When presented with a banker acceptance, the issuing bank promises to pay the bearer a specific sum of money on a certain date. Most often, banker acceptance are used in international trade transactions. As an example, an importer can grant a bank acceptance at a later date than the cargo is scheduled to arrive, while an exporter will have received payment in full before completing a shipment.
For the question how banker acceptance is created, banker acceptance will be created when OCBC Bank agrees to make payment on behalf of a client for a certain sum of money at a specific time in the future, and then they will evaluate the customer's creditworthiness and decided whether or not to grant the acceptance. And as for its selling features, it is commonly used in international trade as a way for buyers to guarantee payment to supplier, and it can be transferred from one party to another. Then, it is also considered as a negotiable instrument in trade operations.
Hello everyone, my name is Kumari Somasundaram. My meeting number is 281027. Now I'm going to explain you how does importer and exporter using banker acceptance. A banker acceptance begin with a customer order to OCBC Bank to pay a certain amount of money at future time, often within 6 months. Customer have to submit an application to OCBC Bank along with the bank acceptance draft and supporting document. The draft are accepted by OCBC Bank, which discount it and pay the supplier directly. Then the OCBC Bank can either keep the bank acceptance of its own or sell it in a money market when it face a short position. The customer pay back the loan to the OCBC Bank at the maturity. Now, there are 4 parties who involved in banker acceptance agreement, which is the bank, the customer, the supplier, and the investor of OCBC Bank.
Hi everyone, in my turn I will talk about the obligation and the right of the party that involved in the banker acceptance. So we'll start with the obligation. So first one is the bank. Bank's obligation is ensure the customer of the BA make their payment to the seller when contract reach the maturity. So if the customer didn't perform his payment as a guarantor, bank need to pay for the transaction that the customer has made. So the second one is a seller. Seller after agreed the banker acceptance terms, the obligation is the goods that purchased by the customer of the bank need to be shipped or sent to the customer on time and wait for the payment after the banker acceptance come to maturity. Lastly, the individual or the buyer or the customer, we said, that issue the banker acceptance, the obligation is make the payment on the maturity date and agree and check the goods that have been sent by the seller with good condition and amount. So we go to the right of the parties. So first one is the bank. Bank's right is to charge the customer who issued the bank acceptance when they fail to make the payment on the maturity date they agreed. Some more, bank has a right to not to involve in the documentary transaction between the buyer and seller. Next, the seller has a right to get the payment on maturity date in a correct amount and time, either by the guarantor bank or the customer they deal with. So also the seller has a right to reject or argue the terms stated in the banker acceptance before agreeing the transaction. So as for the part of the customers, they have the right to request to correct or change the term of the banker acceptance that made by the bank. And they have the right to claim the goods and that purchased to send in correct amount and good condition before the payment as the banker acceptance has stated.
A banker acceptance is a type of short-term financial instruments that has a maturity of between 30 and 180 days and provide a guarantee of futures payment from a bank. For the issuance of banker acceptance, the commissions per month is 0.10% with a minimum of 100 ringgit and the cable is also 100 ringgit if applicable. There are also incidental charges which are shown in the figure in this slide. The cost of holding the banker acceptance for the subscriber, which includes commissions of 0.10% per month with a minimum of 100 ringgit and 40 ringgit for the cable price. The incidental charges is the same as shown in the figure.
Now I'm going to talk about the risk and return to the issuer and subscriber of banker's acceptance. Banker's acceptance have a low credit risk. As a result, banker acceptance provides somewhat higher rates than treasury bonds with equivalent terms. A banker's acceptance also is a type of money market instrument that is generally safe and liquid, especially when the paying bank has a good credit rating in which the payment is mostly the bank's obligation. The inability to pay the account holder is a financial banker's main risk, and the banker must be aware of the default risk. Besides that, the impactor may be asked to provide collateral security in the bank's name in order to reduce the banker's risk. The banker will still also faces the importer's liquidity risk even after doing the fundamental examination.
For a banker acceptance, the fees and costs depend on the bank that charges fees and charges. OCBC Bank might charge acceptance commission as per letter of offer, multiple payment above the 3 payments, transaction value below 100,000 ringgit Malaysia, transfer payment use LBG or TAS, postage within Malaysia and outside Malaysia, courier service within or outside Malaysia, overdose charge and special handling fees. The fees or charges listed are exclusive of any government tax that the government of Malaysia may apply now or in the future. The bank has the right to modify or adjust any fees or charges if government tax are imposed on them as a result of a change in the legislation or for any other reason the sum due. For a banker acceptance, the fees and costs depend on the bank that charges fees and charges. OCBC Bank might charge acceptance commission as per letter of offer, multiple payment above the 3 payments, transaction value below 100,000 ringgit Malaysia, transfer payment use LBG or TAS, postage within Malaysia and outside Malaysia, courier service within or outside Malaysia, overdose charge and special handling fees. The fees or charges listed are exclusive of any government tax that the government of Malaysia may apply now or in the future. The bank has the right to modify or adjust any fees or charges if government tax are imposed on them as a result of a change in the legislation or for any other reason the sum due.
As for the official guideline, OCBC Bank must comply with the applicable banking regulation that stated in the BNM, such as those related to the money laundering, anti-terrorism, financing, and customer due diligence. OCBC Bank also must be careful to evaluate the creditworthiness of the applicant and ensure that they have the ability to repay the acceptance. Apart from that, OCBC Bank may require the collateral such as the lien on asset or a guarantee to secure the acceptance and require a margin on acceptance, which is the differences between the face value and the acceptance, the bank's cost of funds. Lastly, OCBC Bank also have to establish a maturity date for the acceptance, which is the date on the which the bank must pay the face value of the acceptance to the holder.
That's all from us. Thank you.